Hey, welcome to Chapter 11, Basics of Capital Budgeting. Okay, we're getting towards the end of the course, and this is we've been leading up to this material since the beginning, since Chapter 1. We've been building and building and building till we get to this chapter. And let's take a step back and think about what we're doing here for capital budgeting, what capital budgeting represents. I like to refer back to the balance sheet here. And remember, we have assets, liabilities, which is basically debt, could be preferred stock, and then you have equity. And so what this chapter is all about is allocating this capital and budgeting this capital to various projects that turn out to be assets. So we're going to look at, and we're going to invest in various assets. So this would be maybe project or product line A, product line B, product line C. This will be fixed assets and other things related to the project. So we need rules and methods of figuring out, well, how should I invest in A and why? Should I invest in B and why, and C and why, and so on? And so we're going to evaluate these projects. So that's what capital budgeting is all about. It's looking at some various rules and criteria to decide whether or not to invest in various projects. And so when we do that, we are going to use the weighted average cost of capital, provided the assets and have about the projects have about the same risk as the firm. We can use the weighted average cost of capital. If the project has a risk slightly higher or higher than the average of the firm, then we'll use a higher weight, some type of premium on top of the weighted average cost of capital. And if the risk is lower, we would have a weighted average. We would reduce the weighted average cost of capital for discounting the cash flows. Okay, so now that's the background. Let's get into some concepts and definitions before we start getting into some of the rules and criteria for evaluating projects. Okay, first thing we want to do is we want to define independent projects. Okay, independent projects. Independent projects are where the cash flows of one are unaffected by the cash flows in another project. So an example would be, your Bank of America, a gigantic bank throughout the United States, and you're looking to build a branch in Maine, a new branch in Maine, versus a new branch in New York State. Well, the cash flows that are going to come about that are going to be generated from the Maine versus the New York State branches, they're going to be separate and independent. One is not going to rely on the other. So that's an important term that'll come up later on. Independent projects. They're unrelated, disconnected from each other. And what's unrelated and disconnected? It's the cash flows that are generated from these projects that are disconnected and uncorrelated among themselves. Another term is mutually exclusive projects. Mutually exclusive projects means basically you accept one project, you can't accept the other project. It's either one or the other. And so that becomes an important concept later on. You may not be able to invest in two projects, but you can invest in one. And a good example is let's say you have a corner lot, and you can build a bank on it, or you could build a restaurant on it, but you can't do both. Okay, so you have some type of situation where you can't do both. Another example might be you could have a conveyor belt system or a forklift system in a warehouse. I guess you could have both, but it probably doesn't make any sense. So you would think that they're basically mutually exclusive for either a forklift system or a conveyor belt system. Okay, now another concept that's going to pop up is the concept of normal and non-normal cash flows. Normal, non-normal cash flows. Okay. Normal cash flows are defined to be cash flows where we spend money today, so the first cash flow is negative. Then we receive cash into the future. Okay, so it's going to look like this pattern. Normal cash flows look like this pattern. You're familiar with it. You spend money today on your investment, like you buy a bond, for example. You buy the bond and it generates coupon interest all the way through. Or you buy a stock and it generates dividends for you. Okay, so those are normal cash flows. Okay, so we need to keep this in the back of our mind for later purposes. The other thing we want to keep in mind is non-normal cash flows. They could be anything but this. In other words, if you have this, those are non-normal cash flows. You start out okay, consistent with the first pattern, the normal, but you're alternating signs on your cash flow. You get positive cash flow, negative cash flow, positive cash flow. That's non-normal. This, non-normal. This, non-normal. It's got to look like this for it to be normal cash flows. Again, that'll pop up later on. So we got independent projects, we have mutually exclusive projects, and we have normal and non-normal cash flows. That's the setup, the basic terminology for the moment to help us get through this chapter. Now, we're going to look at various rules. Okay, we're going to look at various rules. The rules are in methods of determining whether or not these projects are acceptable. We're going to look at net present value, concepts of internal rates of return, modified internal rates of return, payback period, discount payback, is just some of the main players in this, the main methods of determining whether or not a project is acceptable. And so we're going to look at these various methods, and we're going to do some calculations of each, and then we're going to do compare and contrast. And what we're going to find out is among these, what we sometimes call rules, the rule that rules the rules is net present value. Okay, net present value is a concept that uses all of the cash flows associated with the investment, all of them, okay, and discounts them at the appropriate discount rate reflecting risk. And so that's why it's the rule that rules the rules. And let me go into exactly what that is, and then we'll go right down the list. Okay, so net present value. Okay. Net present value is the sum of all the cash flows, the present values of all the cash flows and outflows of the project. So net present value equals, now I'll show you this. This formula looks a little ugly, but it's not so bad. And I'm just using a generic R for the discount rate. But here, this says, look, we're going to discount all of the cash flows at rate R, which will be for most of this chapter, this will be the weighted average cost of capital. Okay. And we're going to discount it over time period time t. And so really what that's saying is, to interpret this, you really look carefully at this. It's telling you starting at time 0. So what we're saying here is, look, you start out at time 0. Here we have our T's, T1, T2, T3. That's actually T0. And so we're going to spend some money, right? Negative cash flow times 0. Then we're going to have some positive cash flow, at least if we have normal cash flows. And we're going to have some cash flows along the way. And we're going to take the present value of each of those cash flows and offset it and net it against today's cash flow. Today's cash flow, by the way, is already discounted. There's no real discounting needed for that cash flow. If you want to do the math, it's the cash flow divided by 1 plus R to the 0 power, because you're discounting it over 0 time, and that's nothing but cash flow over 1. This whole thing is 1. And so you get cash flow of 0. So what net present value is, it's taking the present value of the future cash flows, these guys, taking the present value, summing them up, and then netting it with the first cash flow today. Cash flow in time 0, and that's where the term net comes in. So what this means is, this is a rule for capital budgeting. We're going to invest in a project that will cost this much money, and it will generate these cash flows out in the time. And if the net present value of this project is positive, so when you do these calculations, it means that the present value of these cash flows are greater than the cost, which means you have a valuable project that's going to add to the value of the firm and increase shareholder wealth. So we go back to chapter 1 where we talk about shareholder wealth and how to maximize the value of the firm. This is consistent with it, because if you find positive net present value projects, that means investing in this project will increase the value of your business in your company. Okay. Now, let me give you two example projects that I'm going to use throughout this chapter for analysis. So I'm going to have these two examples, and I'm going to use these examples using on these rules: net present value, internal rate of return, modified internal rate of return, and payback, and discounted payback. So here's the two projects. Let me lay them out. Here's the cash flows. Here's the examples. We have Project L and Project S. And we're going to have a year here on this axis, on this side, this column. 0, 1, 2, 3. 3 periods. Here's the cash flows for them. Simple projects. So here we have Project L. It costs $100, and it generates positive 10, 60, and 80. So this has normal cash flows. Okay, positive, positive, positive. And then the project's over, it wears out, or whatever. Okay, that's Project L. If you were to calculate the net present value of this project, you discount each one of these cash flows back to time 0 and net off the 100, you would come up with, and that's a good exercise to make sure you can do that, you would come up with a net present value of $18.79. Okay, and what I'll do is in a minute, I'm going to show you how to calculate this on your computer or on your calculator, using some new buttons we haven't used before in your financial calculator. So hold on a minute. Let me lay out Project S, and then we'll go do the calculations. Now here we have cash flows for, I should say CF right here, CF cash flows. So here we have cash flows minus 100 for Project S, $70 positive, positive 50, positive 20. Okay, add that up. The net present value of Project S would be $19.98. Okay, and we can do, I could show you, let me show you first before we get to the calculator, the present value of those cash flows. Present value of the cash flows are minus 100, and then I got to tell you what the discount rate is. The weighted average cost of capital is going to be 10% in this problem, and so we're going to discount this $10 at 10% for 1 year. This comes out to be $909 for a present value. Discount the $60 back, 10% for 2 years, $49.59, and then discount this back at 10% for 3 years, and that's $60.11. Add that up, and you get the net present value. I'll recalculate that on a calculator in a second. Here, minus 100. 63, 64, 41, 32, 1503 comes up to be $19.98. So just looking at this, you would say, you know, how should we decide? Now, if these are mutually exclusive projects, one or the other, which one would we pick? We'd pick S, project S first, because it increases shareholder wealth by $19.98, a little bit more than this project does. So you would pick the project with the highest cash, with the highest net present value. That's if they're mutually exclusive. That means one or the other. Now, if these are independent projects, we would accept both. If we had the money to invest in both, we would invest in both of these projects because the net present values are positive. This one would gain $18.79 in shareholder wealth. This would gain $19.98. We had the money, we'd invest in both if they were independent projects. Okay. Now, you might want to look at these projects and look at them carefully. And it's like, well, why did they pick L and S? Well, here's the thing, and it'll pop out later. You'll see, if you look carefully at the cash flows on this first project, L, come later. They tend, the weight of the cash flows tend to come later in time. It's a small number, and they ramp up. The cash flows for project S come sooner. So you invest your 100 and then you get 70 and it starts to decline from there. And so this is sooner cash flows, this is later cash flows. And you know from capital budgeting, or from time value of money in chapter 5, that you'd rather get your cash flows sooner rather than later. And so it comes out in the math in this example to be 1998 at the better project. Now, let's get a financial calculator out. And I'll recalculate this guy right here, and you can on your own recalculate the 1998. We are going to use the CF button on your calculator. And when you hit the CF button on your financial calculator, such as this one, I am focusing. Can you see that? Let's see here. Can you see that right here? The second row, see cash flow right there, net present value, there's internal rate of return. I'm focusing on the second row. Okay, conveniently all laid out here for capital budgeting purposes. The third row is what we're used to seeing, where we did general present value calculations. So we can still use the third row, and I can show you that, but we're going to specifically make use of the second row of those buttons. So if I press the buttons here, let's see, hit the CF button. So I hit the CF button, and first thing comes up is CF0, subscript 0, cash flow 0, obviously, right? So we're going to put in 100 for project L, put the negative sign in there, right? Negative sign, hit the plus minus sign to get it in negative, and then hit enter. So now it's entered, and then when you're in the CF button here mode, hit the down arrow to get to the second cash flow, which is the very first cash flow, the very first positive cash flow. That's going to be 10. So we're going to hit 10 and then hit enter. Okay, that's so far is not too bad. Now we hit the down arrow and look what pops up. It's going to ask us for the frequency. How frequent are the cash flows in period 1? And in this course, it's always going to be 1. The frequency is always going to be 1. Your calculator is default to 1. So you're just going to leave it at 1. And the way you leave it at 1 is you just hit the down arrow and skip right by it and go to cash flow 2. And cash flow 2 is 60. So we hit 60, enter, down, skip the frequency of period 2. It's just going to be 1. Skip it, go to cash flow 3. And we're going to hit 80, enter. Now, we're basically done at this point after we hit in cash flow 3, because this project only has 3 years worth of cash flows, and so all the cash flows after year 3 are 0. So we want to make sure that that's exactly what your calculator has in it, because if you did a problem previously, and you'll do numerous problems with your calculator, you may have done in your previous problem a problem that had 5 cash flows, 5 years of cash flows, in which case CO4 right, would have been a number. And you want to make sure that that's 0. Make sure CO5 is 0 and so forth. Make sure that that's zeroed out. Okay. So now, once you have that in, the cash flows, and you've made sure that the cash flows beyond the life of the project are all zeroed out, you're going to hit net NPV right here, the NPV button, and it's going to ask you for an interest rate. Capital I is the interest rate, and you're going to put 10. That's our weighted average cost of capital, not 0.10, just 10. Hit enter. Oh, there it is. It's registered in there. Right now, hit the down arrow, and it's going to have NPV, and it'll say 0. At this point, what you want to do is hit compute. And I hit compute, and out comes 1878. And that's exactly, well, 1878.28. Within rounding, I got a rounding of a penny here difference, but there's our net present value for Project L. And if you did the same thing for Project S, you'd come out with the 1998. Okay? So that's how you use your cash flow buttons. It's great. This CF button is great when you have varying cash flows. So notice, this was not an annuity because the cash flows were varying. And so this cash flow button works great, provided you only have a few cash flows. It'll get tedious if you have 10 cash flows. So it's good with varying cash flows for short-range projects. Now what I want to do is jump into the next rule. The next rule is internal rate of return. And you might ask, and it's a valid question, okay, if net present value rules the rules, why are we looking at these other rules? Well, it turns out that these other rules are used a lot in the real world. They've developed, and people have reasons for using some of these rules, even though that they're a little treacherous, meaning that they're if you don't use them properly, and you could make some serious mistakes in capital budgeting using some of these rules. But if you understand them, you're in a much better situation. And the point here is that we want to understand these rules, because these rules are used, these various rules are used throughout industry for good reason. This internal rate of return calculation is going to give us, for example, and it's going to not give us it's not going to give us a decision in dollars. It's going to give us a decision in percent. And some people really like to compare things in terms of percent. I mean, we looked at the yields on bonds, for example. We looked at dividend yields. We looked at coupon yields. We looked at capital gains. So rates of return are big in the world. And so this is a measure, internal rate of return, is a measure that we can compare the IRR, the internal rate of return on this project, which I'll show you how to calculate in a minute. And if the rule basically says is, look, if the internal rate of return is greater than the weighted average cost of capital, then that means it's an attractive project, because the project is returning this, let's say it's 15%. It's returning 15%. Which is greater than our cost of capital of 10%, that means this project is generating an extra 5% above what we require, given the risk of the project. So that's an attractive project. All else being equal, that does make sense. The only, not the only problem. There's several problems with internal rate of return, and we'll see that this is measured in percent. It really doesn't tell us the increase in shareholder wealth, which is measured in dollars. If I walk around, we don't have percentages. We have billionaires measured in dollars, and millionaires, they're not measured in percents. So shareholder equity on the balance sheet is measured in dollars. Share prices are measured in dollars. So this doesn't necessarily tell you the gain in dollars that you're going to get. So keep that in mind. And there's some other issues with it that I will unpack as I develop this method. So the internal rate of return on a project says basically it's the discount rate that sets the present value of the future cash flows equal to the cost. So that, in other words, you have a net present value of 0, because if the present value are your future cash flows, so here's your timeline. here's your future cash flows. They're all positive. Get rid of that thing. They're all our cash flows are positive in the future. So we take the present value of all these guys and net it out against the cost here. And what we're going to do is we're going to set that when we do this netting, we're going to make sure that the discount rate that we're looking for, we're looking for the discount rate basically that sets the present value of these cash flows equal to the costs. So in other words, we are looking for enforcing this project to have a zero net present value. And the way we're going to do that is, so you have net present value of 0, and that is going to be calculated as the sum from t equals 0 right here, times 0, t equals 0 through n of the cash flows at time t, each cash flow 1 plus IRR to the t. So this is what we're looking for. What is that interest rate that gets us to a 0 net present value? Now, this, without a financial calculator, is a real headache, especially if you have more than, say, 2 or 3 cash flows. Trying to come up with the interest rate. You know that from Chapter 5, Time Value of Money, when we asked you to calculate an interest rate. It's a big polynomial if you have more than 2 time periods, and it becomes nearly impossible. And you have to rely on your financial calculator to do the calculations. Your financial calculator will estimate this, as it did in Chapter 5 in Time Value of Money and Yield to Maturity in the bond chapter. It's going to use trial and error, which is why sometimes your calculator goes blank for a couple of seconds. It goes blank because it's searching for a solution. It's searching for this internal rate of return to force this net present value to be 0. So that's what's going on underneath. So the way so let's look at your calculator and see how it's done. So the way it's done is, look, you leave all the information we had from the problem in there, which is convenient. It's already in the registers of your calculator. So hit the IRR button right here, the IRR button. Okay, we hit the IRR button, and out pops 18. And we should hit compute, by the way. It was 18 in there. It was in there because I had recalculated this before I did the video. The IRR for Project L turns out to be 18.125%. Okay, and if you did the same thing and put in Project S, the internal rate of return for Project S would be 23.56. Which, you know, if the projects now, so here's their 2 internal rates of return. And now we have to ask ourselves, which projects do we accept and which ones don't we? Well, if these were mutually exclusive, it was either one or the other, we would accept the sooner S project because it has a higher internal rate of return. It generates a high rate of return. And not only that, but it's greater. IRR for Project S is greater than the weighted average cost of capital of 10%. So if they were mutually exclusive, it was one or the other, we'd pick S, just like we did with net present value. So you see, so net present value is the winner here. It wins in terms of the rule for internal rate of return. It has a higher internal rate of return. Now, if these projects were independent and we had the cash to invest in both, we would take both because both of these have internal rates of return greater than the weighted average cost of capital. So these projects are generating returns that not only cover the costs of the projects, which, you know, there's negative cash flows in there for the costs of implementing these projects, but the positive cash flows are in there also. Okay, but these interest rates are reflecting the cost of capital, which are not buried in those cash flows. Another important point that I alluded to earlier was that internal rate of return is identical, well, it is the same thing as the yield to maturity on a bond. And remember how we calculated the yield to maturity of the bond. You had a bond. Let's say it's a 3-period bond. Right? you pay $1,000 for the bond. Let's say that's how much it cost us, and then we would get, maybe $100 back, $100, and then we get a big cash flow at the end of $1,000. And when we calculated the yield to maturity on the bond, we looked for the interest rate that set the present value of these cash flows equal to the cost. That's what was going on with yield to maturity. And if you remember, when you hit for I/Y, the interest rate on the calculator might go blank for a second as it searches and iterates through and looks for that yield to maturity. Well, a bond looks no different than a project from a cash flow perspective. So you spend $1,000 on a project and it generates cash flow of $100, and then $1,100. That's just a project. So yield to maturity on a bond and the internal rate of return, they're the same thing. Okay. Now, what I want to do is move forward, and I want to look at a concept called net present value profiles. Okay, NPV. Whoa. NPV profiles. So whenever you hear the word profiles, at least in this course, you're going to be looking at a graph in a minute. That's going to do some comparisons. So what we want to do is we want to look at these net present value profiles, because those net present value profiles will help us better understand and be able to compare and contrast net present value and internal rate of return. So that's what I'm doing here basically. I'm going to graphically and mathematically compare the two and see where there's some issues with respect to internal rate of return. We know there's no real issues with net present value, but there's going to be some issues with internal rate of return, and they'll pop up here in this this short discussion here. So let's look at the weighted average cost of capital, and we're going to look at the net present value of each project here. Oops. So here we started off, and I'm going to round a lot of stuff. So I'm going to look at 0, 5, 10, 15, and 20 weighted average cost of capital. We started off assuming a net present value, a weighted average cost of capital of 10%. And then on a rounded basis, we came up with the 1879. So I'm taking these numbers and I'm just going to round them for our purposes here. So that came out to be $19, and it came out to be $20 for Project S. Now, if I was to change the interest rate on these, and this would be a good exercise to work into your calculator, just change the I, the capital I in your calculator when we do those cash flows, and re-estimate these net present value numbers using a weighted average cost of capital of 0. And when you do a weighted average cost of capital of 0, you're just adding the cash flows. There's no discounting, right? The cash flows, there's no discounting of those cash flows. And so you add up the cash flows, and that amount, it's going to be $50. So 100 plus minus 100 plus 10 plus 60 plus 80 comes out to be positive $50. And with Project S, it comes out to be $40 positive. Okay. Now the rest of them, you will need your calculator. You could try the 0 with your calculator. You'll get a consistent answer. But you'll get, with 5%, you'll get 33 here, 29. And let's go down here. You'll get 7 and minus 4, 12 and 5. Okay. I'm going to take these numbers. I'm going to graph them in a minute. But let's look at what's going on here. Notice when I increase the discount rate, the net present values go down, right? That's basic chapter 5 stuff, time value of money. If the discount rate goes up, the present values drop, and obviously the net present values will drop also. So interesting, you get to a point where you have a discount rate so high, you can actually have a negative net present value. Okay? So now what I want to do is I want to graph these and think about now what happens with the internal rate of return. So I just did strictly net present value calculations, but what I want to do is think about where the internal rate of return is. And you can see, you can kind of get, before I go leave this slide here, this view, you can kind of realize that internal rate of return is where the net present value becomes zero. So if you thought about where does this become zero, it becomes zero right here for this particular project, right? So somewhere between 15 and 20% is the internal rate of return for project L. And that if you extrapolate down further this way for project S, eventually it goes negative down below here. So if you went to 25%, you would be negative. I don't know what the negative would be, but it would be negative. Okay, which means right about here, somewhere between 20 and 25% is the internal rate of return for project S. Okay. So what I want to do is I want to graph these relationships and plot and when these numbers are going to pop out on the intercepts. This will be the internal rate of return, and you can see that here. We know the answer. We got it back here. We know that this actually comes out to be 18.125%, and that this comes out to be 23.56%. We know that in calculating, but even if we didn't know that, we would know that they would be somewhere in this area, in this vicinity, just by graphing this out or plotting this out. Now let's graph the thing. Let's graph this concept. And this graph is tricky, so I advise you, normally when you look at graphs, they're not hard to interpret, but this graph you're going to have to look twice at, more than twice. So I'm going to have discount rate on this axis in percent. I'm going to have NPV on this axis. And I'm going to have 5, 10, 15, 20, 25%. And I'm going to go as high as, I'll go up to 60 here. Basically, I'm going to use this as a range for my numbers here. I'll go as high as 60, and I'll go 50, 40, 30, 20, 10, and 0. Okay, now I'm going to try to draw this as best I can. Let me graph this. So let me graph L here, and so I'm going to graph these numbers with these discount rates basically. And so when the discount rate is 0, right here, the net present value of project L is 50. So right there is L. That's where project L starts. And project L crosses the x-axis. It crosses right here at the internal rate of return at 18.125%. It crosses. So if I draw that, it's going to be, this is always hard. So I draw it like this. Looks something like this. Actually, it'll have a little bit of a bow shape to it. These graphs will have a bow shape to them. It didn't really come out too well in there, but they do have a slight bow to them. Just like by the way, the prices of bonds. When we did the price of bonds, bond price, and we had yield to maturity here, we had things that look like this. Well, same concept, because a bond is a project. Okay, so just imagine there's some curvature there. Now let's do project. I'm going to get a different color here. Let me use red to try to accent this. Let's graph the net present value for S, and it's going to start out at 40 right here. S will start out right here at 40, and it'll cross at 23.56. We know it's somewhere between 20 and 25 just by doing these calculations. We know it's between 20 and 25, and we said the internal rate of return was 23.56. So 23.56 is right here. 23.56%. Okay, right there. So let's see if I can get that to, and try to get some curvature in there. So it'll go like this. Okay, pretend that there's curvature there, much like this. I didn't quite get it, but it's there. So the point is now that you got these two net present value profiles. So these profiles of the graph, and the red is project S, and the black is project L. When you look at for all these numbers that are graphed here, all of it applies from here above is all net present value calculations, everything. The only point that represents internal rates of return are these points right here, these 2 points. Everything else on the graph represents net present values, and then you see net present values going negative. Just like we saw here, the net present value starts to go negative as you go below the 18%. Okay. What we want to do is compare and contrast this, and what we see here is, so we're comparing and contrasting internal rate of return and net present value. And what we see here is that sometimes net present value is higher for project L, right? It's the better project here, but if you have a discount rate that's high, that's higher than this crossover rate, and we'll talk about this crossover rate in a second, but project S is the better project here. So L is the better project at this point. S is the better project here. So which one is the better project depends on the discount rate that's being used. Okay. Now, and if you look at, which is the better project according to internal rate of return, you got a definitive according to internal rate of return. It says, look, the winner is S, because look, it has the highest number going in this direction. It has the highest number, it's higher than this guy, so S is the winner, right? But what we're saying is it truly the winner? It depends on what your weighted average cost of capital is and where you are on this discount, where you are on this graph. Okay? So with a 10% internal rate of return, right? So come up here with a 10% internal rate of return, we squeaked out. I mean, there's a $1 difference, $19 to $20 basically. Here, it didn't quite come out on the graph, but this is the difference right here, is the difference of $19 to $20. Right here, that's that $1 difference. And you can see that S wins. S wins because it's 20 versus L at 19. Okay? But what if the weighted average cost of capital had been less? What if the weighted average cost of capital was 5%? If it was 5%, L would be the better project. And we can see that in the numbers. Take a look at the numbers. If you compare these two, right? L is the winner. L is the winner. Ooh, there's a flip. There's a crossover. There's a crossover between these two. And the winner here is S. S is the winner. S is the winner. And so on. So somewhere it crosses. It's crossing at a rate, and this is the crossover rate, where the net present values equal. So somewhere, if this is the winner and this is the winner, let me put this here. If this is the winner here for L, and this is the winner S here, somewhere these present values, these net present values equal. There's a discount rate somewhere between 5 and 10 where these two numbers right here equal. That's the crossover rate. And when you determine we're not going to calculate the crossover rate in the class, but it's a little tedious, and it's not important to actually pin it down. You can graph it and come close. What we want to do is we want to see, like here, we want to see when there is agreement and disagreement between internal rate of return and net present value. And that's another dimension, another angle of what we want to do here. We see that S is the winner here at this point, and S is the winner all the way here according to net present value. So remember, if you ignore these 2 points, everything else is talking net present value. Okay, so net present value, the winner here, net present value, it's consistent with internal rate of return, which is the winner. When you're looking at internal rate of return, just on this axis. So from here, see if I can go from here to here, from here on, IRR and net present value are consistent. They give you the same solution. In other words, the winner is S when you have a weighted average cost of capital that's high, okay, then S is the winner, and that's what internal rate of return is telling you. So now, when you're below the crossover rate and you're here, you get a conflict. Conflict between what? You get a conflict between NPV and IRR. You get a conflict because, look, net present value is telling you L is the winner, but IRR is telling you S is the winner. They're in disagreement. And you might ask, well, why is there a disagreement? Why is there in this particular case? Well, it has to do with the timing of the cash flows is the ultimate source of this problem. Let's see if I can get these cash flows back up. The ultimate source of the problem are these cash flows. And the timing of the cash flows. It's really, in this case, it's the timing. In that project L, you have these cash flows that come very late in the life of the project. And if you have really high discount rates, then what that does is those discount rates are to the cubed power, to the squared power. It's discounting these. And so when you have high discount rates, that's up above in this area. So here's high discount rates. It's discounting these big numbers a whole lot because you're taking $80, for example, and dividing it 1 plus a very high weighted average cost of capital. It's very high. To the third power, it means it's going to reduce that number significantly. Whereas Project S, those cash flows later on are very small, so they don't really get discounted that much in dollar-wise. There's just not much of an impact. That's why Project S wins at high discount rates. Okay, so that explains why there is a crossover and inconsistency between net present value and internal rate of return in this example. In certain cases, depending on where the discount rate is. So there's 2 reasons why you see, in general, crossovers in net present value profiles. There's 2 main reasons. One is the timing of cash flows varies, and we just saw that in this example. The other problem that comes up is the scale. It's called scaling problem. Scaling differences. Scale just means size. You remember economies of scale from economics, and it has to do with size, scale. And in this course, and in this chapter, scale has to do with the size of the initial investment. They're equal in this case. So this scaling difference doesn't pop up in this problem because they're the 2 projects of the same size. So scaling is not the problem here. The problem is the timing differences. Later versus short-term or sooner cash flows. Which brings up another issue, by the way. If you had projects that had different scales to them, what you'd find is that you have internal rates of return of projects with two different scales. You could have a project that has a 20% internal rate of return and another one that has a 5% internal rate of return, and it could actually be that the 5% internal rate of return is the better project. Now, how can that be? I just told you the higher internal rate of return is better. Well, it could be, this could be a $1 billion project that earns an internal rate of return of 5%, and say and it's greater than our weighted average cost of capital. Say the weighted average cost of capital is 4% for some reason. It's low. This would be a better project than, say, a $1 project that earns an internal rate of return of 20%. So you get internal rate of return on $1. Who cares? But a $1 billion project, well, 5% is a lot of money. So what increases shareholder wealth more? Well, the $1 billion project has a bigger impact because it ultimately translates to dollars, which is what we want to translate everything into ultimately. So the point is, internal rate of return ignores scaling differences. And so you can't simply look at internal rate of return by itself. You need to look at the differences in the size of the projects, which ultimately is what net present value does for you. Net present value takes the scaling into effect. So it took into consideration the size of these cash flows to come up with the size of the net present value. Now, let me show you something that you would never think of. It's quite mysterious. It's very hard to see, but there's underlying assumptions going on about reinvestment. So I'm going to talk about reinvestment assumptions that are made in both internal rate of return and net present value, that you would, like I said, you just never would think about this, or would ever realize that this is the mechanics going on underneath it. And it took people a long time, people in finance and economics who spent quite a long time working on these calculations to figure this out. And so it's these differences in reinvestment assumptions that may cause problems with using internal rate of return, is the point here. And so here I'm going to give you a couple of things, a couple of items here. Net present value assumes, the method assumes the cash flows are reinvested at the weighted average cost of capital. Okay? It assumes that, and I'll show you in a minute that it assumes that. Internal rate of return, on the other hand, assumes cash flows are reinvested at the IRR, the internal rate of return. And it sounds like I'm talking in circles, but I'm not. So what I'm saying here is these differences in the assumptions can cause problems between the two calculations. And what I'm saying here is, look, the appropriate opportunity cost of money is the weighted average cost of capital. So when we get cash flows and we're assuming we're reinvesting them at the weighted average cost of capital, that's a reasonable approximation for our cost of capital and our opportunity cost of money. So this is a reasonable assumption. Internal rate of return, on the other hand, assumes that cash flows are reinvested at the internal rate of return. What happens if you get let's say you get a 30% internal rate of return for a small project? It's really good. It's just a small one. It's assuming that the cash flows are getting reinvested and earning 30%. But it could be just that you had one particular project that did really well, and that the cash flows that this project is throwing off and generating, in other words, can't get reinvested at 30%. It can only get reinvested at something close to the weighted average cost of capital. Then if that's the case, then this assumption is unrealistic for internal rate of return, which is another reason why the net present value rules the rules. It has to do with this reinvestment assumption. Now, the only way you're going to see this is if I do a problem and I show you an example. So here we have an example. The internal rate of return on this project is 30%. And here's the project. Spend $1,000 and you get 300, 300, and then 1,300 back at the end. Okay, there are the cash flows. Normal cash flows, in a sense, negative, positive, positive, positive. Okay, the internal rate of return. So go back to your calculator, hit the cash flow button, right? Hit in 1,000, hit the plus negative sign, enter, down, 300, enter, down, skip the frequency, 300, enter, down, down, last cash flow 1,300, enter, down. Oh, make sure that the cash flows after are all zeroed out, and they are. Now I hit the IRR button, and it says 0 for the moment, right? But I hit compute. And notice it's blank for a second, and it just thought about it. It searched, and it found it at 30%. Okay? So there's the calculator telling you it's 30%. Now what I'm going to tell you is that that calculation assumes that these cash flows are getting reinvested at 30%, which is really high. So let's see. Take this cash flow, you're going to get 300 in year one, and if you reinvest it, $300 times 1.30% squared for 2 periods, 2 periods, this comes out to be $507. This cash flow gets reinvested for 1 year at 30%. That comes out to be $390. Add the 1,300. So add these three numbers together. We come up with future cash flows of 2,197. That's the future cash flow, taking these cash flows and investing them at a rate of 30%. We generated year 3 future cash flows, $2,197. So now let me calculate the interest rate that gets us from the 2,197 to the 1,000 up to the $1,000. What is the interest rate? Just call it R. That gets us from 2,197 to $1,000 over 3 years. So I'm discounting the 2,197 by some rate R. When we solve that rate, we get R equals 30%, which is equal to the internal rate of return. So we see that the internal rate of return, underlying assumption to the internal rate of return is that those cash flows are being reinvested at the 30%. We can see that better if we assume a more realistic interest rate. Let's see what happens if we assume a realistic interest rate. 30% is high. You just can't most companies can't reinvest at 30%. You know, maybe a small project or so will generate 30%, but you won't be able to reinvest those cash flows at that high rate. So let's say you can reinvest the cash flows at a more realistic 6%. Let's see what happens to the interest rate that sets those cash flows equal. So do the same analysis. 1, 2, 3. We spend $1,000. We get 300 back, and then 1,300 back. So take the first cash flow, grow it at 6% for 2 periods, comes out to be 337.08. Second cash flow, grow it at 6% for 1 period, comes out to be 318.00, and then add the 1,300. So add these numbers up, and you end up getting 1,955.08. And so the interest rate that gets us there gets us back to the 1,000 point is R equals the 25.04. That does not equal the internal rate of return. It's less than the internal rate of return. So the point is, if you're showing a 30% internal rate of return, but you can only reinvest those cash flows at a more realistic number, then you're overstating the profitability of the project. It's more in line with the 25% than it is the 30%. And that these differences would be magnified if we had a project that went a lot more periods. Okay, so keep in mind that what I just showed you is basically this was a bond. This was a bond, and we just did a yield to maturity calculation. And the yield to maturity calculation assumed that the coupons that come off the bond are reinvested at the yield to maturity. In the bond market, interest rates are more realistic. It's set by the market, but projects are not traded in the market. So the fact that they're not traded in the market, you can have some small projects that are really profitable and some that are not. But this project, if it did have a yield to mature, a 30% internal rate of return, you can't reinvest those cash flows at 6% in all likelihood. And so if you found a particular bond also, you may have a yield to maturity on a bond of a bond to 30%, but that's kind of high, but you're probably not going to be able to reinvest those cash flows at 30% on the bond. So the point is, internal rate of return and yield to maturity are the same thing. A bond is a project, and a project is a bond. And so these interest rate assumptions underlie both internal rate of return and yield. Now let me show you quickly that net present value reinvestment assumptions are such that net present value assumes that the cash flows are reinvested at the discount rate. So the way to do this is, I'm going to give you a two-period project. Throws off $120, then $11.20. Okay, so that's the project. And so if I'm telling you the interest rate is 10% for this project, discount those cash flows back, and what's the project worth? The project is worth, this cash flow discounted back at 10% is 109.09. This cash flow discounted back 2 periods is 925.62. So the net present, or the present value of this project with those cash flows, basically the present value of these two cash flows, not the net present value, just the present value, is $1,034.71. Now if I spent $1,034.71 for this project, then the net present value would be 0, because the present value of the cash flows would equal the cost. So the net present value would be 0. Okay, that's not what I'm trying to show, but just making sure we're on the same space. Now, how do I know that these calculations assume that the cash flow has been reinvested at the 10% rate? How do I know that? Well, take this cash flow and reinvest it at the 10% rate. So move forward, and I only have one cash flow, so it's 120 times 1.10 to the 1 power gives me $132. $132 plus the 1120 up here, and 132 comes out to be 1252 future value. Okay, so 1252 discounted at some interest rate I gets us to 1,034.71. What is that interest rate? Oops, to the second power, by the way. I turns out to be 10%, 0.10. And so you can see that net present value calculations assumes that we're reinvesting these cash flows that we get from the project at the interest rate, the discount rate. So again, to summarize, internal rate of return and yield to maturity assume cash flows are reinvested at the yield to maturity or internal rate of return, which could be extraordinarily high in some cases and unrealistic. Whereas the net present value calculations assume that cash flows are reinvested at the discount rate, and the discount rate is typically a reasonable number. So now let's think about a way to try to fix this internal rate of return problem, this reinvestment assumption. There is actually a way around it, And now what I'm doing is I'm going to get into what's called modified internal rate of return as the next step. And the modified internal rate of return takes internal rate of return, adjusts it or modifies it so that then we can actually use internal rate of return without worrying about problems with reinvestment assumptions. And so the modified internal rate of return, MIRR, is the discount rate that causes the present value of the project's terminal value to equal the present value of its costs. Okay, present value of the project's terminal value to equal the present value of its costs. Yep. Terminal value is found by compounding forward inflows at the weighted average cost of capital. I basically already showed you this method, but I didn't use the term modified internal rate of return. I basically used that concept when I was computing, when I was showing you reinvestment assumptions here. So when I was calculating these R's, I was basically doing modified internal rate of return, but I just wasn't calling it that. And let me set it up now to talk about that. So we know there's the problem with internal rate of return and reinvestment assumptions. The modified internal rate of return tries to fix that problem, and it assumes that cash flow are reinvested at the weighted average cost of capital. Let's see. What am I talking about? What are these terminal values? Well, let's use project L as an example. So recall project L, where we start at the very beginning, cash flow negative 110, 60, and 80. Okay, so let's map that out. Minus 100. 10, 60, 80. Now, let's apply modified internal rate of return to this. The weighted average cost of capital in the problem was 10%. Remember way back? I said, look, the very beginning, here it is, 10% weighted average cost of capital. So let's take the cash flows and reinvest it, and we call this a terminal value. It's a future value. Book calls it a terminal value because terminating at 0.3, but it's okay. So it's 10 times 1.10 squared gives us $12.10. This 60 compounded at 10%, 10% for one period gives us $66. And we add the $80. So we're adding these three numbers together. Sums to be 158.10. That is called the terminal value in your textbook in this application. Terminal value. Hey, it's a future value. It is a future value of these three cash flows. And so now what we want to do is find out what is the modified internal rate of return for this project. Well, what we want to do is we want to take that and discount, what is the interest rate that discounts this back to the 100, that's $100. What is that discount rate? So it's 158 as being the future value divided by 1 plus, and this will be MIRR. I was using R before I was using the concept of modified internal rate of return. Oops, 3 here, and that has to equal 100. What is the interest rate that gets us there? Well, it's the modified IRR, and that turns out to be, in this case, 16.5%. Okay, so this project really, if you assume reinvestment at 10%, you're going to get a modified internal rate of return of 16.5%. Now recall, we had a modified internal rate of return for project L of 18%. So 18% was kind of high. We're not likely to get be able to reinvest these cash flows at 18%. So the fact that this still is an attractive project, but the reinvestment rate is now more realistic, and so the return is 16.5%. Now, the decision rule: if MIRR is greater than the weighted average cost of capital, invest in the project. Invest. Okay, so that means it's acceptable. And so you want to find the projects with the highest modified internal rate of return. Okay, and to make your decisions, when you have mutually exclusive, it's either one or the other. You'd pick the one with the highest modified internal rate of return, provided that you're careful about the scaling of the project, and if you make sure you have the same scale, because look, this could be a modified internal rate of return for a $100 project, but what if you got a 15% modified internal rate of return for a project that was $1 billion? Which one would you pick? The $1 billion project, because in terms of dollars, it's going to contribute to your shareholder wealth much more than this little investment here of $100. There is another problem with internal rate of return, and let me show you. There's another problem that you wouldn't realize either, and that has to do with multiple internal rates of return. Multiple internal rates of return. Multiple IRRs. Now, what does that mean? Well, let me discuss this and use an example. So here's the example. We have a new project, not L and S. We're going to use project P in this case. Okay, new project. Cash flows minus 8 million. That's 800,000 negative. Then cash flow 1 is 5 million. And cash flow 2 is negative 5 million. Okay, so let's make sure we got the signs right here. It's negative, positive, negative. Ooh, non-normal cash flows. So here's where that term non-negative cash flows shows up. We have non-negative cash flows, and look at this. Look at the cash flows carefully. What would that represent? What kind of project would you spend money up front, get some money, and then not lose money, but spend some more money? You could think of it as, the classic example in capital budgeting is, look, you want to build a dam, say, in a remote area, and you need to build the cement factory right next to the dam. It makes sense to build the cement factory right next to the dam. So you build the cement factory, and it costs you some money, and then you have to tear the whole thing down and fix the environment and everything else. And so at the end, you have to spend money to clean up the situation. So you spend some money, you get some money from the selling of cement, and then you tear the whole thing down, and it costs you money, something like to that effect. Okay. Point is, we have non-negative cash flows, and let's see what happens when we do some calculations. Let's do before we go further. Let's do NPV, net present value, to get a handle on things. See where we are here. So we got minus 805,000, and then negative 5,000. Okay, everything being here in thousands of dollars. So everything's, add 3 zeros to everything. So we calculate the present value, let's assume a weighted average cost of capital of 10%. And we discount everything back, we get a net present value of minus 386.78, which right off the bat tells you stay clear of this project because it costs you more than what you're going to make. And so when you see a negative net present value, since it rules the rules, it's telling you stay away. It's negative. Okay, but let's say you didn't have access and you weren't looking at net present value. You were using internal rate of return to evaluate this project. So you're a company, and for some reason you don't know anything about net present value. You don't like net present value, and so you're using internal rate of return. What are the pitfalls here in this situation? Well, as title says here, multiple internal rates of return, and so the question is, which internal rate of return are you going to is the appropriate one? Now, before we go further, we can do the calculation on this calculator. On my calculator here, let me clear it out here. And we're going to hit cash flow. Let me get the cash flow zeroed out here. We're going to put in minus, so I'll put it out. I don't have to show you. Put in 800, change the sign, enter. Cash flow 1 is 5,000, enter, down arrow. Cash flow 2 is minus 5,000, enter, down arrow. Hit IRR, and when you hit IRR and then compute, your calculator will go blank for a second, and out will pop, at least out of my calculator, pops out an internal rate of return of 25%. You say, oh, okay, that sounds good. It turns out if you have other calculators besides this one, the BA2 Plus, you may get an error. Your screen may say this, or it may just go blank and stay blank. It may give you an error. And the reason why it's giving you an error is that there's more than one internal rate of return, and your calculator can't figure out which one to use and which one to go to, and it gets confused basically. Let me show you why. Let me graph this. So here we have weighted average cost of capital. Here we have 0. And we're going to have NPV on this axis, and so I'm going to show you a net present. This is the net present value profile. It's not going to look like the profiles that were before. The profile is actually going to look like this. That's the profile, and it turns out that where it crosses the axis, just like it did before in those profiles, where it crosses the axis is where the internal rate of return is. So this is net present value. And this is net present value 1 of 25%. Okay. Down here is minus 800. And how do we get minus 800? $800,000? Well, if you have a 0 discount rate, weighted average cost of capital is 0, so go all the way down here to 0. 0, you're just adding up the cash flows. And so if you add up these cash flows, it comes out to be minus $800,000. That's how we get to this point right here. As the weighted average cost of capital goes up, your discount rate goes up, up. You'll get to a point where you have a net present value of 0. Then the net present value goes positive, positive, positive. And it'll go up to close, somewhere around $450,000. Come down, and it'll go 0 again, and it'll go 0 at the 400% level. And then you'll have a weighted average cost, and then the net present value goes negative and stays negative. And so the question is, which is the right internal rate of return? It can be confusing in a lot of projects. So you need to be aware of this particular problem. Okay. Now, why does it do this? So let's try to get into the interpretation of this problem. So look, at very low discount rates, and I say low discount rates, I'm thinking in terms of this axis here, and I'm at low discount rates here. At low discount rates, the present value of the second cash flow is large and negative, so the net present value is negative. See, net present value is negative here, because look, you're taking, this is minus 800, this is 5,000 minus 5,000 in period 2. Okay, so what we're saying is that very low discount rates, this cash flow stays about the same. It doesn't get discounted very much, this $5,000. So this is still a huge number, and it overwhelms what's going on here. It overwhelms this guy. Between the 800 and this number, overwhelms the 5,000, and it forces you to have a negative net present value. Once you get above 25%, right, things go positive, and then let's see what happens when we get really high up, really high discount rates. We get really high discount rates, and that present value is also below zero. It's negative. And so how does that work? Well, at very high discount rates, the present value of both these two cash flows, 1 and 2, are low. So this shrinks a whole lot. When you have really, really high cash flows, this shrinks down to nothing. This shrinks down pretty small. And what overwhelms everything is this negative 800. So that negative 800 is what's causing this to happen. And so it's because of those dynamics that you get two internal rates of return. So the reason why this happens is because of the multiple IRR issue, the multiple internal rates of return. And so the more sign changes you have, so you go, remember this was, when we had normal cash flows, we had one internal rate of return. But if we have cash flows like this, we're going to have an internal rate of return for every change in sign. So you got to change here, then you got to change here, then you got to change here, then you got to change here. You're going to have multiple cash flows that are equal to the number of sign changes, and so that's going to be a concern. So what do we do? What do we do in this situation where we have non-normal cash flows? Can we use modified internal rate of return to save this project and do the analysis of this project? The answer is yes. We can save this analysis and use a modified internal rate of return with a little twist compared to what we did earlier. This time what we're going to do is when we have non-normal cash flows, we're going to compute the modified internal rate of return by taking the present value of the outflows, right, discounted at 10%, the weighted average cost of capital, and that's going to be the minus 800 right here, the minus 800, and then the other outflow was this 5,000 minus the 5,000 discounted at 10% for 2 periods, so we're discounting it back. So we're taking these two cash flows and we're computing, they're taking the outflows, the negative signs, and computing them to a present value for their costs here. And that comes out to be minus 4932.23. And we're going to compare it to the terminal values for the positive cash flows that are moved forward in time, that the book calls terminal values, which basically is a future value of the positive cash flows. So we're going to take the TV, terminal value of inflows at 10%. So we're going to take this cash flow of 5,000 and grow it at 10% for 1 period to there. Comes out to be $5,500. Okay. Now we're at a point to figure out what is the modified internal rate of return. Okay, so with that trick in mind, that we take the negative cash flows, come up with a present value, compute a future value for the inflows, and now compare them. So we're going to take the 55, the terminal value here. We're going to come up with 1 plus MIRR is what we're solving for, the modified internal rate of return. It's a 2-period problem, and that's going to equal 9432.23, which is the cost of the project in present value terms, which is basically what we did earlier, except with a little twist. And so we calculate MIRR, and we come up with a modified internal rate of return of 5.6% on this project. Wow, 5.6%. That's low. So we would reject this project, reject project P, because the MIRR is less than the weighted average cost of capital. This is 5.6%, which is less than the 10%. We already knew the answer. We knew the answer because the net present value was less than zero. It was minus 300 $86 we computed a little while ago. But the modified internal rate of return is giving us a consistent answer here, consistent with net present value. Okay, we have actually two more methods to analyze here, and they're very related, so I almost think of them as the same thing. They're so closely related, and that is payback period and discounted payback period. Okay, that'll be the last two. Now let's do a little comparison here. Remember, we did net present value, and the result came out in dollars, right? And then we used internal rate of return and modified internal rate of return, and these guys came up with a solution benched in percents, interest rates. Now the next two calculations, payback period, is going to be measured in years. So this basically gets at, how long does it take to recover the project's costs? In other words, how long does it take to get my money back is what this payback is trying to get at. There's some pitfalls with it, and I'll talk about those pitfalls as we go along. So let's take a look at how to calculate payback. And its payback period is basically what we're trying to calculate. It's calculated by adding project's cash inflows to its costs, which is a negative cash flow, until the cumulative cash flows of the project turns positive. No, that doesn't make any sense. Let me explain with an example. Okay, we have project L again. Here's project with the cash flows that come in later than the sooner project. So here we have cash flows, 3 periods. Remember, we had minus 100, we had positive 10, positive 60, and positive 80 for the cash flows. Now, we almost always in this course put things horizontally in doing the calculations, but I would suggest, and it's I think a lot more intuitive, to look at payback vertically. We're going to do things vertically now, and here's what we're going to do. I'm going to take the cash flow here, and then I'm going to take the cumulative cash flow. Okay, and then when that cumulative cash flow becomes positive, as we go down this direction, as we go down this way, then that's going to help us determine our payback period. So here's what I mean. The project cost 100, right? That's where I got there. And then we had 10, right? And then we had 60, and then we had 80. Okay? The way I like to think of it is, look, we dug ourselves a hole 100 feet. We're in the hole by $100 or 100 feet. I don't know, maybe you think of yourself as being financially in the hole $100, right? And then you got to use these cash flows to dig yourself out of the hole. Okay? And so when you do that, if you take the $100 and you add the $10 positive, you're still in the hole by 90. And if you add the next $60, you're still in the hole by 30. And now, when you add this next $80, right, you dig yourself out of the hole somewhere between 60 and 80, which, by the way, think of it in terms of years here. This is 0, 1, 2, 3. Somewhere at 2 plus X years, we pay ourselves back according to this calculation. And the thought is, the faster a project pays itself back, the better it is, because you get your money back faster, and projects that get their money back faster are deemed to be less risky, because if you get your money back faster, it's easier to predict cash flows for the next year or two, but try to predict cash flows 15 years from now. It's nearly impossible. You don't know what the market's going to be for your product. You don't know what the competition will be at that point. You don't even know if the product will exist. So it's very hard to estimate cash flows far out in the future. So This tries to get at it by saying, look, if you have a project that pays itself back really fast, that's an attractive project. So this project is paying itself back in 2 years, plus a little bit more. Now, what is that cutoff point? Well, we are going to take this $30, right? We need to get to the point where we recover this $30 using this $80. So we're going to take, it's going to be 2 years plus 30/80ths of the year. We're going to assume this $80 comes in nice and smoothly throughout the time period. And so this will come out to be 0.375. So overall, it's going to take 2 years, 2.375 years to recover our money on this particular project. So the payback for L is 2.375 years. The payback, if you do it for S, would be 1.6 years. Okay. Which is the better project? S. Well, S, is the sooner. The cash flows come in sooner, so you should expect it to pay itself back faster. It does. And you want the lowest payback period. It pays itself back the fastest. And so here's the winner according to payback. Now, right away you can see there's problems with this. And one of the big problems, there's a couple of problems with it. The biggest problem is it ignores the cash flows. If we had cash flows of $1 trillion in period 4, 1 trillion here, we'd be completely ignoring that in the calculation. And so payback doesn't cover all the cash flows, and we have to cover all the cash flows, and so it doesn't do that. Not only that, see, the payback, you'll never be able to fix payback for that problem. The other problem with payback is a little more subtle, slightly, probably not as big of an issue, but it's an issue when interest rates are high. It's the fact that we haven't discounted anything. We just added up some numbers. We haven't really taken time value of money into consideration. The whole course, we've taken here is about time value of money. So we can try to fix payback for that one weakness. And so we're going to use discounted payback to do it. And what discounted payback is going to do is going to take time value of money into consideration. So here we're moving into a concept of discounted payback. It's basically what we just saw. Instead of going horizontally, let's do it vertically. And so we're going to have year. We're going to have cash flow, just like we had before. Oops. And then we're going to have the present value of the cash flows, and we're going to discount things at 10%. We're going to take because that's our weighted average cost of capital, discount these cash flows at 10%. So this is minus 100. This will be 9.09, 49.57, and then 60.11. Okay, that's their cash flows. Now let's look at our cumulative cash flows. Okay, so we're going to do the same the same concept of, we dug ourselves a hole of $100. Now, when is it going to take us how long is it going to take us back just to get ourselves out of the hole? So we have $100 negative. We're going to add 9.09 to it. And when we do that, we come up with 99.1. So we're negative. We're still in the hole by almost $91, but we're going to add $49.57 to it on the next shot, and we're still going to be down $41.32. And then we're going to add $60.11, and somewhere between year 2 and year 3, we go positive. So it's going to be 2 years. We know it's going to go 2 years plus 41/32 out of the $60.11. That's the fraction of the year, assuming the cash flows come in nice and smoothly. That's the fraction of the year. that turns out to be 0.70. So payback is 2.7 years, okay, for L. So discounted payback for L is 2.7 years. And you know, we know you can do the calculation for S, but we know that S will pay itself back faster, even on the discounted payback period. But notice what happens with discounted payback. It takes a little longer to pay ourselves back because we had to discount all those positive cash flows. So we had to discount all those positive cash flows. It pushes things back. So we had a discounted payback period, or a regular payback period, 2.375 years. It's now 2.7, and you'd find the discount, this payback period will go up, but it won't go as high. It won't go numerically as high as this. So what will happen is the discounted payback for S will be less, and it'll indicate the winner. The winner will be discounted payback for S, and you can do that calculation on your own. There's one more thing that I did not consider so far with payback and discounted payback, and that is when you do this analysis, you have to have a cutoff period in order to decide whether or not you want to accept the project. Now, we know that the shorter the project, the better. The sooner it pays itself back, the better. So when you look at payback for L and S, obviously S is the better project. You know, if these projects are mutually exclusive, you would want to pick the one with the shortest payback. And the same thing with discounted payback, pick the one with the shortest payback. But what if you have a criteria that says a decision rule that you've made up, and that's the point here, you've made it up because there's no other way to do it, is that you say to yourself, I'm only going to accept projects that have a payback of 2 years or less. And so if you made that up, then what would happen is you'd be picking S, no matter which version you use, payback or discounted payback, but you would have to reject project L because the cash flows are coming in too late. So there's an artificial rule that you have to develop when you implement discounted payback and payback. And so that is a weakness of it. You know, who's to say 2 years, you know, makes sense? Why not 2.5 years? Why not 3 years? That again is what it's often called an ad hoc rule on how to make a decision with these criteria. So now is a good time to review and summarize all that we've covered here. Okay, so let me give you a quick review. We started out with net present value, and in net present value we used all of the cash flows, and we came out with an estimate that was measured in dollars, and we said if net present value is greater than 0, you know, that's an attractive project in and of itself because it adds shareholder wealth. Okay? And we said that if we have mutually exclusive projects, one or the other, you'd pick the one with the highest net present value. If they're independent, you could pick them all, provided they had a net present value greater than 0. And that was the first one. That was the rule that rules the rules because it looks at all cash flows and it discounts them and considers risk. We then looked at internal rate of return and modified internal rate of return. Remember, internal rate of return had the problem of reinvesting cash flows at the internal rate of return, which may be abnormally high and unrealistic. So modified internal rate of return fixes that by assuming a weighted average cost of capital for reinvestment purposes. This is measured in a %, and we said that we would accept projects if the IRR or the modified IRR is greater than the weighted average cost of capital, assuming that the projects have the same risk. And that's what we're dealing with in this chapter for the most part, the same risk as the firm. Projects that have about average risk. So yeah, you got to be able to cover your cost of capital, and that's what these rates of return are telling us. If these rates of return on these projects are greater than the weighted average cost of capital, we've recovered all our costs, including the cost of money, the opportunity cost of money. Now, if the projects are mutually exclusive, meaning one or the other, you would pick the project with the highest internal rate of return. Okay, and then if they're independent, you could pick all of them, if provided the rates of return here are greater than the weighted average cost of capital. Be careful. This applies. You have to be very careful about this because you have to check for the scale of the projects. In other words, you could have a project that's for a $1 project with a good high internal rate of return and a $1 billion project with a average rate of return. Which one's better for you as a company? The $1 billion project, because it'll add to shareholder wealth. So keep that in consideration. Internal rate of return is just a percent. You lose the scaling effects. And the other thing is you got to make sure that you're looking at normal cash flows when you're doing this to avoid the potential of, especially with internal rate of return, avoid the double, 2, 3, 4 different internal rates of return you can have if your cash flows are flipping signs back and forth. Modified internal rate of return will fix that for you. So modified internal rate of return can help with two aspects. It can help with non-normal cash flows, and it can help with flipping non-normal cash flows, and it can help with the reinvestment, a realistic reinvestment rate. Then the last things we covered was payback and discounted payback, and those were measured in years. And we said that we want projects that pay back as fast as possible. So we want these payback and discounted payback to be as low as possible. They're the better projects, the lowest possible. And we have to make up a cutoff period to decide which projects are acceptable. And if you have mutually exclusive projects, you'd pick the one with the lowest discounted payback, provided it meets your criteria, your cutoff, say of 2 years, for example, in the previous problem. If it's 2 years or less, you'll accept it. So, and then if you have independent projects here, you would accept all of the projects if their payback was less than your artificially decided cutoff period, say of the 2 years. So that's a quick summary of all these rules. They're used, in the real world. Your textbook talks about that. I've seen them used in the real world. I've seen net present value, internal rates of return used, and payback used in the real world. It's out there, and so we're covering. Even though these rules are not the best rules and are very, very tricky, the point is, in finance, you should be aware of these rules because they're out there and being used.